Hello students, this is Professor Vincent Osaya. Welcome to my class. This is part 6 presentation of chapter 16. Chapter 16, Dilutive Securities and Earnings per Share. In part 5, we illustrated how to calculate EPS in a simple and capital and complex capital structure. Now, we are going to continue on that part by talking about illustrating complex capital structure further with slight modification of what we just discussed in part 5. So let's take a look at this example. In 2013, CE issued at par 60 $1,000 8% bonds, each convertible into 100 shares of common stock. CE had revenues of $17,500 and expenses other than interest and taxes of $8,400. Now the tax rate is 40%. Throughout 2014, 2,000 shares of common stock were outstanding. None of the bonds was converted or redeemed. So we are now to compute diluted EPS for 2014, and we are going to assume the same fact as we discussed in part A, except for the fact that here 60 bonds were issued on September 1st, 2014, all right, rather than in 2013. So let's take a look at how that works out. So the first thing we need to do is to calculate the net income based on the facts. So the revenue 17,500, expenses 8,400, bond interest expenses 4,800. Then we have income before taxes of 4,300, 40% tax rate 1,740. So the net income or the net profit is 2,580. So now for computing EPS, the net income is 2,580 as just recently computed, and we said that the weighted average shares is 2,000. So we have a basic EPS of $1.29. Now let's modify that with the variables that we just talked about and compute diluted EPS. So the first thing that we do in computing diluted EPS is to compute the basic EPS. Just like we did, the basic EPS is $1.29. So take a look at the adjustment that we are going to make. The interest expense that was taken into consideration in calculating the net income, we now have to add it to the net income because the assumption here is the bonds are going to be converted to common stock. Therefore, the interest expense is no longer relevant for net income computation purpose. So we add back the interest expense for the 800 net tax. So the tax rate is 40%. So 40% of 4,800 minus 4,800, or a shortcut will be 4,800 multiplied by 1 minus 40%. So that would do it in terms of adjusting the net income relative to the interest expense in connection with the bond. Now, we now have to assume that the bonds has been converted to common stock. So that results in additional 6,000 shares of common stock. So if you do the math, we now have a 5460 on the numerator. That is income, net income as adjusted. Now we now have 8,000 shares outstanding. So if you do the math, we now have a 0.68. So bottom line is the diluted EPS is now 68 cents versus basic EPS of $1.29. So the potential investor now realize that if the bonds are converted, we are looking at EPS of 68 cents and not $1.29. So the EPS has been diluted. Now, let's go ahead and make a slight adjustment to that illustration. Here, the same fact, except for the fact that we said that the bond was issued during the year, not at the beginning. So for the last 4 months of the year, so we now have to make that adjustment for 12. So the bond interest expense is now only 1,600. Then the income tax is 40%, that is 3,000. So the net income is 4,500. Pretty much the same thing that we just illustrated. Now the basic EPS is $2.25. After that slight modification. Now again, we need to go ahead and adjust or add the interest expense net tax to the net income, and the 6,000 potential additional common stock shares has to be multiplied by 412 to take into consideration that it was in existence for the last 4 months of the year. So if you do that, we now come up with diluted EPS of $1.37. Moving along, let's take a look at the additional illustration of complex capital structure. Okay, here prior to 2014, PB company issued 4,000 shares of 6% convertible cumulative preferred stock, $100 per value. Each share is convertible into 5 shares of common stock. Net income for 2014 was 1.2 million. There were 600,000 common shares outstanding during 2014. There were no changes during 2014 in the number of common or preferred shares outstanding. So now our challenge now is to compute diluted earnings per share for 2014. Now, so let's take a look at how that works. Again, we are going to go ahead for the basic EPS. We are going to take into consideration the dividend of the preferred stock. All right. So we calculate the dividend of the preferred stock. As you know, we already discussed this previously. 40,000 shares multiplied by $100 per value multiplied by 6%. So there are one of two ways that we determine the dividend of preferred stock. For a preferred stock with the percentage, one way of determining the dividend for preferred stock is the dividend per share is given to us as a specific amount, or it is a percentage of the par value. So in this case, the par value is 100. That 6% means 6% of $100 par value multiplied by 40,000. That will give you $240,000 in dividend. So like we discussed earlier, we have to back out the preferred stock dividend from the net income for the calculation of basic EPS and divide that by the weighted average shares of 600,000. So when we do that, we are now looking at the basic EPS of $1.60. Let me quickly back off here. I want you to know here that in this illustration, we are zeroing in on preferred dividend now versus bond in the previous example. So moving along, we have already calculated the basic EPS, so let's deal with the diluted EPS. Okay, so again, the same. Okay, so the basic EPS as previously computed is $1.60. So let's take a look at the adjustment that we are going to make in terms of calculating the diluted EPS. Now, at this point in time, look at what is going to happen. We are now going to add back so for the basic EPS, like we just demonstrated, $1.2 million, which is in net income, we back out the preferred dividend of $240,000. Take a look at what we are having here. We are now adding, so we subtracted $240,000 preferred dividends for the purpose of computing the basic EPS. Now we are adding the $240,000 preferred dividend. Why? Because here we are assuming that the preferred stock has been converted to common stock. Therefore, the dividend relating to the preferred stock is no longer relevant. So we add the $240,000. So as you can see, for the purpose of computing diluted EPS, the 240 is a wash. So we add back the $240,000 for a diluted EPS computation purposes. Now, take a look at what happened. Now, the additional 200,000 shares resulting from the conversion of preferred stock to common stock also has to be taken into consideration in the numerator. So when you do the math, now we have a 1.2 million numerator on the denominator 800,000. So we now have $1.50 as diluted EPS. The basic EPS is 160, diluted 1.5, meaning if the preferred stocks were shares of stock were converted to common stock, if the diluted EPS will be $1.50. Now, moving along, let's assume we are going to change this example slightly by way of saying now we are assuming that each share of preferred is convertible into 3 shares of common stock. So if that is the case, look at the basic EPS still remains as $1.60. Nothing changed there, okay? Now let's take a look at the difference. Now, of course, we are still going to add back the preferred dividend on the numerator. We just explained that. Let's take a look at this. Now, we are now assuming that the preferred stock is convertible into 3 shares of common stock. So we now have 120,000 shares here, instead of the $200,000 that we had previously. Now, when we do the math, if you do the math, you are going to find out that the diluted EPS is now $1.67. So you need to count this. What happened here? Look at basic EPS is $1.60. Diluted EPS is now $1.67. So it's actually higher than the basic EPS. Don't forget now, the purpose of going through all these troubles in terms of calculating diluted EPS is to warn the potential investor that if convertible securities are converted into common stock, there's a possibility that the EPS will be diluted, will be decreased. But here, the opposite happens. Basic EPS is $1.60, but the diluted EPS is $1.67. So we give that another fancy name in accounting. We call that anti-dilutive. Anti-dilutive. So now, here is the accounting rule that you need to know. Whenever we have anti-dilutive EPS, it is not reported. It is not reported. In other words, you are not required to report it according to GAAP. Why? Because it defeats the purpose of calculating diluted EPS in the first place. So moving along, let's take a look at the diluted EPS options and warrants. What are we talking about here? Here, unlike, I don't think we are going to have, I just need additional 7 minutes to wrap up this chapter, but I don't think we are going to have enough time to do that in this segment. So I have to wrap up. We have to start part 7 of this presentation from this point. I really didn't mean to have 7 videos for this chapter. Well, nevertheless, it is what it is.